When you hear about prices changing directions in the news, the reality is that the market has probably shifted directions. This means that if you're looking solely at price movements to figure out what's going on in the real estate market, you're probably at least 1 month too late. So instead of just looking at price, in this video, I'll go through a few leading indicators for Toronto real estate so that you can react more quickly. Interest rates, days on market, and my favorite, sales to new listings ratio. Before I start, if you enjoy content like this, don't forget to give this video a thumbs up and subscribe to our channel so that you can see more videos like this made specifically for real estate investors in Toronto. We know price is a lagging indicator. So what are our real estate leading indicators? The first one is interest rates, which can be a good indicator for end user markets. In general, end user real estate markets typically move inversely with interest rates. In our current rising rate situation, the markets at the highest risk would be the GTA because they have the most end user homes in the mix. Toronto has a better balance of end user homes and investment properties, so we might see more diverging trends here, with those most affected on the downside by rate hikes being the higher end detached homes, while condos and investment freeholds will be less affected. I'm not going to dive too deep into how interest rates affect real estate prices here because I've already talked about this before. But if you're interested in knowing more about this, definitely head over here to learn more about this. Another leading indicator for real estate is days on market. In a hotter market, we tend to see more bidding wars and bully offers, so naturally properties don't sit on the market for too long. My issue with the days on market indicator is that it can be manually manipulated. In extremely competitive environments, listing agents like to set offer dates and not accept preemptive offers. So the days on market number usually bottoms out at around 1 week. On the other hand, when a property sits too long in a buyer's market, the listing agent can relist the property and effectively reset the days on market. As you can see, even though days on market can be a good supporting leading indicator, I'd say that it has its flaws. So this brings me to my favorite leading indicator, the sales to new listings ratio. The sales to new listings ratio is a pretty straightforward calculation. You take the number of sales during a given month and divide it by the number of new listings during that same month. When you compare the two, you get a good idea of the supply and demand momentum in any given month. And when you compare this ratio between months, it'll help you understand whether the market is getting hotter, indicated by a higher number, or cooler, indicated by a lower number. When you read about this ratio online, you'll probably see that typically when the sales to new listings ratio is above 50%, the real estate market is considered a seller's market, and below 50%, it is a buyer's market. In my opinion, I'd probably tweak that a little bit more and say that if the sales to new listings ratio is above its average levels, then you can expect faster price growth coming soon. And when the sales to new listings ratio is below its average levels, you can expect prices to drop soon. If we look into history a little bit more, you'll see that this is true, and Toronto real estate prices do follow the ratio, typically lagging behind the sales to new listings ratio by a few months. Let's see it in action by looking at the 416 condo history. On this chart, the red line is the sales to new listings ratio, and the blue bars are the annual price changes for condos. As you can see, the blue consistently follows the red and is slower by a few months. When we take a closer look at 2020, you'll see that the red line, the sales to new listings ratio, started to nosedive in March of 2020 and stayed in buyer market territory for the rest of the year. Shortly after the ratio nosedive, the drop in condo prices followed. The ratio dip in April matched the price dip 2 months later in June. The small sales to new listings ratio retracement from May to July matched the price retracement later on from July to September. Then the condo market started to show signs of recovery in January of 2021, and so a few months later, condo prices started to recover starting in April. I'd say right now, the sales to new listings ratio still indicates a strong Toronto condo market with the sales to new listings ratio sitting above average levels. And I don't see any signs of this ratio changing directions, which is good if you're thinking about investing in the Toronto condo market today. Let's go to Toronto semis next. At first glance, you might quickly notice that Toronto semis are a much hotter market than Toronto condos in general, with a higher average sales to new listings ratio. This means buying conditions are tighter overall in semis, so even when the market cools, 416 semis see much stronger support, fewer overall price fluctuations, and a lower chance of big price drops. Right now, the 416 semi market is balanced, sitting at its average sales to new listings ratio levels, and there's no obvious signs that the market sentiments are changing. Switching over to 416 detached homes, the sales to new listings ratio is still hovering at average levels, but there are bigger swings and some signs of plateauing. I don't see any major red flags here yet, but it's something to keep a closer eye on. In general, the 416 market looks so far so good, but things are pretty different in the 905. In the 905 detached market, the sales to new listings ratio has dropped to its average levels, but it's actually never been at these levels since June of 2020, so that's a first warning. If we continue to see a decline in the sales to new listings ratio, then the 905 detached prices should soon follow downwards in the coming months. The most obvious sign of weakness, however, is actually in the 905 semi market. Its average sales to new listings ratio is 69%, but right now, 905 semis have transitioned into a visible buyer's market at 42%. This is a telltale sign that markets have obviously shifted and prices are coming down very soon. With inflation staying high, you probably don't want to hold too much cash and want to find a secure investment to hedge against inflation. Yes, real estate can be a good inflation hedge, but you have to understand that real estate is not one consistent class and they don't all move in the same direction. With more volatility in the real estate market ahead, you need to choose your investments wisely. We're seeing central banks trying to curb inflation, and recently they've appeared more hawkish with interest rate hikes. If this pans out and we see faster than expected rate hikes, we'll see end user markets hurting the most. On top of the sales to new listings ratio pointing to a weaker 905 market, we're also seeing lagging indicators in price drops already happening, with prices falling month over month in places like Brampton, Oakville, Stouffville, and Simcoe County. The key takeaway is that if you're looking to enter the market, I encourage you to take the time to learn more about where the individual markets are headed. If you're confused still and want to get an expert to help you out, let's chat. We can talk about real estate market trends, but more specifically, we'll look at your requirements and preferences to match you up with the best opportunity that fits your investment goals. After we help you buy it, our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us if you want to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.